Hi there, I welcome you again to this last chapter of our course on Candlestick for the beginners. Over the course of previous 4 chapters, we got introduced to what are candlesticks. We learned about various single candlestick pattern, we learned about multi-candlestick pattern, and in this chapter, which is the last chapter of this course, we'll continue our discussion on the multi-candlestick pattern. The first candlestick which we'll talk about might bring a giggle out of your face when you hear the name, but trust me, it is different from what it sounds. The pattern which I'm talking about is called the Harami pattern. It is not the Hindi word, it is actually a Japanese word which means pregnant. Now, if you look at the images on the right hand side of your screen, you see the images are like a belly formation. The first bullish Harami candlestick, the first candle is a big red one, and the second one is a small green one, which is completely inside the body of the first red candle, which means it's like a pregnant woman shape. Similar for a bearish Harami, the first candle is a green one and the second is a red one. So which is where this word comes into picture. This is generally a trend reversal pattern. Now, which is important for us to understand that the prior trend here could be bearish in case of bullish Harami and could be bullish in case of bearish Harami. But once this formation happens, there's a very good chance we could see a trend reversal in the market. The first candle is a big one, as you can see on the screen, and it is followed by a small candle which is completely engulfed by the previous candle. The color of the second candle is generally different from the first candle. In case of a bullish Harami, say the first candle is a red one, then the second candle, which is completely inside, would be a green one. And in case of a bearish Harami, the first candle would be a green one and the second candle would be a red one. Now, this is very important. If the second candle here, which is the body, if you can see the picture, turns out to be a doji candle, the chances of reversal increases even more because it shows more indecision, and which is where the reversal chances also go up. Now, let us talk a little bit more about the bullish Harami pattern. The prior trend here in the market is a bearish one. If you can see the image on the right hand side of the screen, there are 3 red candles and they're actually making newer lows on regular basis. But once the formation of the Harami candlestick happens, you can expect reversal from the market, and which is where the prior trend is bearish, but once the formation happened, we can expect a bullish reversal. And if you can see the picture, I have marked a box which is marked in yellow. The first candle is a red one and the second candle is a green one, which means second candle is a green one and it could also be a doji candle. So the pattern of the bullish Harami gets confirmed only upon the formation of the second candle. So we have to wait for the formation complete for us to be confirmed about the formation of pattern. The idea here is to go long at the formation of the pattern. If you're holding shorts, it is best advised to book your profits and look out for taking long opportunities in the market. So this is how a bullish Harami chart would look on your screen. The prior trend here is bearish. Once the formation happened, we can see bullish candles forming in the chart. Now the next point is this: when does one choose to enter a trade in the formation of a bullish Harami pattern? So the risk-taking trader would go near the formation of the candles. Basically, as and when the formation takes place on that particular day, near the closing of the market, he would execute his longs and wait for the trade to work out on the next day. But a risk-averse trader would wait for the pattern completion and would execute his trades on the next day. Now, what is the difference between two trading styles? So in case of a risk-averse trader, the success rate is higher because you're waiting for the pattern to complete. But in case of a risk-taking trader, you have a better chance of maximizing the return because you're entering on the same day. Just in case the market gaps up on next day, you are still a part of the day and the trade is already making money for you. Now, where does one put a stop loss? The stop loss in this case is always below the second candle, which is the green candle or a red candle, depending on the bullish Harami or a bearish Harami, and it is below the candles. So the stop loss is predefined if you are taking trades based on this pattern. Now, how does one decide the profit target? Actually, there is no hard and fast rule for profit target. It is best advised to keep trailing a stop loss and ride the gains. As and when the trailing stop loss gets triggered, you book your trade. But as long as the trading stop loss is not triggered, you can always keep milking on the money which you're making using this trade. Now, what exactly is a bearish Harami? It's an exact opposite of a bullish Harami pattern. The prior trend here is a bullish one and it's a strong bullish candle, and the prior pattern is continuously making new high. But once this bearish red candle happens, you can start to see panic setting among the buyers. They are actually thinking, what happened? Why is the market not going up? And which is where the stop losses get triggered and they start booking their losses, and the fresh short starts entering in the market. One should actually ideally exit to look his longs if he's holding longs in the market, or look for shorting opportunities if he is position neutral and he doesn't have any position in the market. This is how a bearish Harami chart looks like. Now if you look at the square which is marked at the middle of your screen, the prior trend here is continuously making fresh highs, but upon the formation of bearish Harami candlestick, you can see the pattern reversal and you can see the kind of movement which you see in the market. Only by trading a stop loss you could have captured the whole move in this pattern formation. Now how does one enter trade using this pattern of bearish Harami? The risk taker again would execute or enter his trade on the formation of second day candle near the close of the day. And a risk averse trader would wait for the pattern confirmation, and upon the confirmation is when he enters his short position in the market. The stop loss again for this candle is above the doji candle or the red candle, and you can keep riding the grain by trading the stop losses. So this is a simple Harami pattern. You have both bullish Harami pattern and the bearish Harami pattern, and these are generally trend reversal trades in the market. The next pattern which I want to talk about are the candle gap formation. So what is the gap formation? The gap formation is that pattern in which the open or close of the next day is significantly above or below the previous day close. There is a massive price gap and it actually tells a lot about the momentum in the market. Now if you look at this picture on the chart, this is a nifty chart. You can see both bullish gap up and a bearish gap down. The bullish gap up is when the opening of the next day is significantly above the close of the previous day, and a bearish gap down is that pattern in which the open for the next day is significantly below the close of the previous day. So those are two gap patterns in the market. So what is a bullish gap up and why is this pattern formed? This pattern emerges when you hear positive news or positive sentiment in the market. The market is expecting newer highs being formed, and these kind of news generally comes overnight and the market gaps up on the next day itself. A gap up and gap up also happens for particular company stock when there is something overnight positive news about the management, the company is receiving some orders from the market, or you're expecting positive quarterly results. So these are situations when you see positive gap up in the market. Now when you see a bearish gap down, this is actually a negative sentiment of the market. If you're hearing that overall there's a negative news in the market, or even if all the global indices have performed weak overnight, you can expect bearish gap down in the market. And in case of stocks of the company, this happens when you hear some negative news about the management, or you're hearing some defects in the order, or expecting a weak quarterly results. So these are the scenarios where you can expect bearish gap down in the market. Now this is again chart of Nifty which we showed earlier. There's a bullish gap up and a bearish gap down, and you can see the impact of that on the market. The market gapped up and you could see momentum still continuing, and the market actually went above 400 to 500 points. Similarly, for a bearish gap down, we see almost 400 to 500 fall after the gap down happened in the market. So these are strong pattern. These don't occur that frequently, but once they occur in the market, they actually provide significant trading opportunities. Now moving on to the next candlestick pattern, and it is one of my favorite. It is called the morning star candlestick pattern. So this is a 3 candlestick pattern. As you can see, it's already been marked on the box on the right hand side of your screen. This is a bullish candlestick pattern. The prior trend is bearish, but upon the formation of this pattern, you can expect bullish momentum in the market. This pattern generally indicates trend reversal in the market. Why trend reversal? Because the prior pattern is bearish, but upon the formation of this 3 candlestick pattern, you can expect the market to become bullish. A significant move up cannot be discounted upon the formation of this pattern, because it shows zeal among the bullish traders in the market, and we could see panic setting among sellers in the market. Now this is how a chart looks like. If you can see, the prior trend here was bearish, but upon the formation of this 3 candlestick pattern, first was red, second was a doji candle or a small green candle, and the third one is a strong green candle. And so you can be rest assured that the momentum is turning on the upside. Now how does one use this pattern? So this is the prior trend here is bearish, and the market is continuously making fresh lows and it's touching the newer lows in the market. The first candle here on the formation is a red candle, and we can see that the momentum on the weakness is continuing, and again the second candle also starts below the previous day close, which means we're expecting more bearishness in the market. But what happens? You don't see that negative momentum in the market. The sellers try to push it down, but we see buying momentum coming in and the buyers are taking over the market, and they don't let it form a red candle. They make it either a doji candle or a small green candle. And the third candle starts significantly above the second candle close, and which is where you can see massive panic buying amongst the sellers. They just want to exit their position, and we can see fresh longs being executed or initiated in the market. So this is how a morning star pattern is formed. So how does one take a trade? Upon the formation of third candle, if you're a risk-taking trader, you can trade on the close of the third candle, and if you're risk averse, wait for the pattern completion and take your longs on the next day. How to put a stop loss? Put your stop loss below the low of the third candle, which is the confirmation candle, and there's a good chance that the trade will work, and you just keep writing your gain by training stop losses in the market. The last and the final pattern of this course which we talk about is called the evening star pattern. This is an exact opposite pattern of the morning star pattern. It's a strong bearish reversal trend in the market. This is a 3 candlestick pattern. The prior trend here is very bullish. It's continuously making fresh highs, but upon the formation of this candle, you can see panic coming in the buyers, and we can see stop loss booking, and the trend could be continuing on the downside for days to come. How to use this pattern? The prior trend, as I already told you, is bullish, and it's continuously making fresh high. Again, the first candle in this pattern is a very strong green candle, and the second candle opens significantly above the first candle. You can expecting the market to be bullish even on this day. But what happens? The seller kick in, we can see profit booking from the bulls, and we can see fresh short position being initiated. And the third candle is when we see confirmation coming in the market. We see regular selling, and we can see a big green candle formation, and you know that the evening star pattern is complete. Now this is how a chart looks of the evening star pattern. You can see the prior trend has been a bullish one, and you can see the market again here. It looks like there's a consolidation happening, and we can see the green candle which I marked here is when the evening star pattern starts. The second candle is doji, and the third candle is a big red candle. So you can be rest assured, okay, that the market is looking like it's going to come down, and we can see supports being tested in the market. So this was it from us in this course of Candlestick for Beginners. I hope you got a decent understanding of all the major single candlestick and the multi candlestick pattern. Do let me know if you have any questions regarding any pattern. I'll be more than glad to clarify you. And if you haven't understood any pattern, I would request you to keep going through the chapters again and make sense out of it. Most importantly, to be in complete understanding of candlestick, keep practicing out on the real charts, because practicing on the real chart, you get a better feel for the market and for the trade. I again thank you, and I hope you have a great time learning. Thank you so much.